Global markets are stable this morning after solid US retail sales data. Strong Australian employment growth keeps the spotlight on the Reserve Bank of Australia ahead of its rates decision next month. The Bank of Korea unexpectedly holds rates, and there was a price shock in December for those trying to fly out of New Zealand. That's coming up in our 5 Things in 5 minutes. And then in today's deep dive interview, ANZ Head of Australian Economics Adam Boyton looks ahead to what's in store for Australia's economy through 2025.
This isn't like a story in some other economies where central banks have needed to ease aggressively because economies have been in recession.
But first, in 5 and 5 with ANZ. In global markets overnight, stocks and bonds held on to their gains after those benign US inflation figures on Wednesday night. The S&P 500 and Nasdaq were up around 0.2% this morning, and the 10-year US Treasury bond yield fell another 4 basis points to 4.61%, and currencies were broadly stable. Meanwhile, the Australia's unemployment rate rose slightly to 4% in December, as expected. But with the data showing surprisingly strong employment growth of 56,000 people, ANZ senior economist Adelaide Timbrell says the unemployment rate has been able to stay in a tight range due to record high participation.
So a lot of people have entered the labour market either by moving to Australia or coming out of retirement or coming from being a discouraged worker and trying again to get back in, partly because, job vacancies are up and the labour market is quite tight. All of that has led to really strong employment growth in December. Now, December was 56.3K. That was really strong. But when we look at overall Q4 employment growth, so the number of extra people in jobs, it's very similar in percentage terms at 0.7 as last year in Q4.
As of 4 a.m. Sydney Melbourne time, the US dollar index was flat after US retail sales were in line with expectations. The Aussie dollar flat too at 62.23 US cents, and the Kiwi flat at 56.17 US cents. Number 2, expectations for a rate cut in February by the Reserve Bank of Australia fell slightly yesterday from 70% to about 2/3, following those stronger employment figures. Adelaide says the RBA will have to balance the data against easing inflation.
The risk of a strong labour market is when there's few extra people looking for work, there's more power for the people in work to ask for wage increases, which can create more inflation. Now, that creates a risk for the Reserve Bank because the more inflation that could be coming down the pipeline, the less that they can cut rates. In saying that, the Q4 CPI outlook, our forecast is that it will be at 0.5% trimmed mean, which is a really nice number for the Reserve Bank to be cutting rates. And at the end of the day, the inflation is the number one for them.
Number 3, South Korea's central bank held rates at 3% yesterday when markets had expected a cut. ANZ economist Crystal Tan says the Bank of Korea shifted its concerns to a weakening currency and the potential increase in pressure on inflation.
In Korea, the recent rise in global oil prices, because South Korea is a net energy importer, there can be a quick pass-through to domestic retail prices if you have both oil prices and a weaker currency in combination. So this appears to be the main cause for today's pause. But I think what's also notable, though, that the forward guidance was actually very dovish. All 6 committee members, excluding the government, did signal an openness to a rate cut in the next 3 months.
Number 4, GDP data from China later today will reveal whether 2024's target for 5% growth will be met. ANZ senior China strategist Xiaopeng Xing says his forecast for Q4 GDP would be enough for the calendar year growth to be rounded up to 5%.
We see Q4 GDP at 5.3% year-on-year. This is one of the highest on the market. The reason behind it is the outperforming service sector, which has benefited from the policy support and also the low base last year. We see China economy is on a solid recovery course at this moment.
Number 5, people buying tickets to leave New Zealand in December faced a surprisingly high 29.6% rise in international airfares from November. That's according to selected price indices data out yesterday. It's the last data ahead of Q4 CPI figures next week. ANZ senior economist Miles Workman says while the bump should reverse out, the slightly stronger than expected partial data has led ANZ Research to increase its forecast for CPI inflation in the December quarter.
Feeding the December month SPI data into our finalised Q4 CPI pick has actually seen us upgrade our expectations slightly for CPI inflation in the December quarter. So we have revised higher our quarter-on-quarter expectation from 0.4% to 0.5%. So that would see annual CPI inflation stable April versus Q3 come in there at 2.2% year on year.
Miles Workman there. Now, on today's Deep Dive interview, ANZ Head of Australian Economics, Adam Boyton, talks with me about the outlook for the Australian economy over 2025.
There are a few things to look out for this year. The first is that we expect GDP growth to pick up. That will be driven by a pickup in spending by consumers. And what sits behind that is that recovery in household incomes, helped by a combination of a few things. The first is the ongoing growth we've seen in employment over 2024, and we think that that will continue into 2025, although not quite at the same pace of growth we've seen. The second thing supporting household incomes is, of course, that tax cut that landed on the 1st of July 2024. The third thing that will support household incomes is the fact that inflation is a fair bit lower now than it was a year or two ago, and you put those things together, and that says that after inflation incomes, if I will call it that, what economists call real incomes will actually be growing reasonably solidly through certainly the first half of 2025, but also into the second half. They're the three key things from the activity side of the economy. If I think then about inflation and interest rates, one of the good news stories from the early part of 2025 has been the most recent monthly CPI suggests to us that when we get this all-important Q4 inflation number at the end of this month, Q4 from last year, when we get that number at the end of this month, we're expecting core inflation in Australia will only have risen 0.5% in the quarter. That will be a fair bit below where the RBA was thinking, and indeed where we were thinking at the end of last year. And for that reason, we expect that we will get an interest rate cut in Australia in February this year.
So that's one cut. Is there room for the Reserve Bank of Australia to deliver a lot more cuts, given that inflation seems to be beaten?
I wouldn't quite say that inflation's beaten. I mean, we do expect we'll get this good print at the end of this month. The forward-looking indicators of inflation that we track, for example, those price and cost measures in business surveys, suggest that inflation is certainly going to be in the RBA's target band. There are a few wrinkles, as is always the case. The first is that strength in the labour market. Now, there's no sign that that's feeding through into wages growth. Wages growth, we think, will decelerate further. But the RBA, I think in that environment, will be a little cautious about cutting aggressively. This isn't like a story in some other economies where central banks have needed to ease aggressively because economies have been in recession. What we're seeing in Australia is we've had a year of soft growth. We think that we'll see a pickup in 2025. The unemployment rate, when it printed yesterday at 4.0%, is actually below the peaks we saw around the middle of last year. And employment growth through the course of 2024 and growth in hours worked through the course of 2024 was reasonably solid, in fact, quite strong almost. And so the activity side of the economy in Australia is soft, but it's not soft enough for the RBA to need to ease really aggressively. When I think about the sort of interest rate reductions we're going to get in Australia this year, the economy can afford to grow a little faster, but we're going to be cautious about putting too much gas in this engine because we don't want to see a reignition of inflation. I think that's the way I'd characterize that. It's not rate cuts because we're in recession. It's more rate cuts because the economy can afford to grow a little faster. And if GDP growth is going to pick up, it's possible. I don't think this is the case, but our forecasts have the peak in the unemployment rate this year of 4.3%. We saw a 4.2% last year. It's not implausible to say we've actually seen the peak in the unemployment rate already. I expect the RBA will be less aggressive than other central banks. And also, don't forget that the cash rate in Australia only relative to other economies, not only relative to for those people that have mortgage, but the cash rate in Australia peaked below what we saw in New Zealand, below what we saw in Canada. And so the RBA is starting from a lower starting point.
Out of Boyton there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, January the 17th. Catch you next week with a look ahead to the Bank of Japan's rate decision on Friday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.